When entering Vietnam, foreign investors often face a critical question. Should you set up a 100% foreign-owned company, or partner with a local business through a joint venture? At first glance, both structures allow you to operate in Vietnam. But in practice, they offer very different levels of control, risk, and flexibility. Choosing the wrong structure can impact your business for years. A 100% foreign-owned company is a legal entity fully owned by foreign investors. This structure gives you full control over operations, strategy, and decision-making. You are not required to share ownership with a Vietnamese partner. For many sectors such as consulting, IT, and trading, this is a common and preferred option. However, it comes with stricter licensing requirements and regulatory scrutiny. A joint venture involves forming a company with a Vietnamese partner. Ownership is shared between the foreign investor and the local party. This structure is often required in sectors where foreign ownership is restricted or conditional. Beyond legal necessity, joint ventures can also provide access to local networks, market knowledge, and operational support. But they also introduce shared control. One of the biggest differences between these two structures is control. With a 100% foreign-owned company, you retain full authority over business decisions. In a joint venture, control depends on ownership ratios and shareholder agreements. Even with majority ownership, certain decisions may require mutual consent. Without carefully drafted agreements, disagreements can quickly become operational risks. Vietnam applies market access conditions to foreign investors. Some industries allow full foreign ownership. Others require a local partner or impose ownership caps. In restricted sectors such as logistics, education, or certain distribution activities, a joint venture may be the only viable option. Understanding these legal conditions early is essential to avoid rejection or restructuring. In theory, both structures follow similar licensing processes. However, joint ventures often take longer to establish. This is due to the need for negotiation between partners, alignment on governance, and preparation of joint venture agreements. A 100% foreign-owned company can be more straightforward if your sector allows it. But complexity can still arise depending on your business scope. Each structure comes with its own type of risk. For 100% foreign-owned companies, the main challenges are regulatory compliance and licensing. For joint ventures, the risk often lies in the relationship between partners. Disputes over control, profit distribution, or strategic direction are not uncommon. Without strong legal frameworks, resolving these disputes can be difficult in practice. Joint ventures may reduce initial barriers to entry, especially in restricted sectors. However, they can lead to higher long-term costs due to shared profits and potential inefficiencies. A 100% foreign-owned company requires more upfront compliance effort but offers greater long-term independence. Your choice should align not only with your current needs, but also your long-term strategy in Vietnam. Many investors choose a joint venture too quickly, assuming a local partner is always necessary. Others choose 100% ownership without fully understanding licensing restrictions. Some rely on informal agreements without clearly defining roles and responsibilities. These decisions often lead to delays, disputes, or costly restructuring later. The right structure depends on your industry, level of control required, and risk tolerance. If your sector allows full ownership and you want full control, a 100% foreign-owned company is often the better choice. If local expertise, licensing conditions, or market access require collaboration, a joint venture may be appropriate. The key is to make this decision based on legal reality, not assumptions. At LTS Law, we help foreign investors evaluate whether a 100% foreign-owned company or joint venture is the right choice. We analyze regulatory conditions, business objectives, and potential risks. We also assist in structuring joint venture agreements to protect your interests and minimize disputes. Our goal is to ensure your investment structure supports both compliance and long-term success. Vietnam is a high-growth market with significant opportunities, but success depends on making the right decisions early. Choosing between a 100% foreign-owned company and a joint venture is one of the most important steps. Before you invest, make sure your structure is aligned with both your goals and Vietnam's legal framework. Visit lts.com.vn to consult with our legal team and structure your investment in Vietnam with confidence.